All right, Iran has intensified attacks on oil and natural gas facilities, raising the risk of long-term damage to key energy infrastructure in the Persian Gulf. While it's pushed oil higher, precious metals are, as we were just talking about, selling off, and expectations for a Fed rate cut are fading. Is there a method to all this madness? Let's bring in Tyler Mordy, CEO and CIO of Forstrong Global. And Tyler, thanks very much for joining us. So let's ask that. Is there a method to the madness?
Roger, great to be with you. I mean, we live in a very fickle and strange world these days, of course, that goes without saying. But I think the method to the madness is that since the pandemic, we've had 4 major supply shocks. And, the economy's had this sequence of supply shocks hitting the system probably every 12 to 18 months. If you look back, we had COVID, we had the Russia-Ukraine crisis, we had tariffs last year, and now Iran. And each time markets priced in, worst case outcomes, and each time the global economy proved more resilient than expected. And so I think a useful thought exercise, and one we're certainly thinking about for our clients these days, is, what is the market missing? We're obviously in a very emotional time. The headlines are very scary, and this is a serious crisis. But, you look back to all those previous 3 supply shocks since 2020, since the pandemic, Roger, and, there was always something that the market missed. And, with COVID, we had this big supply or policy response. With Russia and Ukraine, we learned that, the energy supply chains around the world are pretty adept. And we saw oil rerouted to India, Turkey, China, that type of thing. And tariffs last year, I think it goes without saying, but we had the president do his famous taco. And markets totally misread that as well. So our investment team is focused on that. The headlines are, as I said, obviously very scary, but we're focused on what the market could be missing right now.
Now, is this the same as 2022, the oil? I mean, we're now seeing places being bombed, facilities being bombed. Is this the same as 2022, or are we looking back more towards 73 with that massive oil shock then?
Yeah, I think a lot of people are trying to put an analog to 2022 or to the 1970s. I think with 2022 it was a little bit different because you were coming out of the pandemic and you had inflationary forces really surfacing, and so back then labor was very tight. Housing was doing very well and everything. So you had a stronger inflationary impulse. So that this time around we have a weaker inflationary impulse. Like before the Iran crisis, we had weak labor, we had weak energy, of course, and we had, at least in the United States, we had a housing market in recession. And so it's a different inflationary backdrop. Now, the 1970s playbook is, I think, Roger, is the one that everyone is going back to. And I think this is the one that matters. And of course, the instinct today is to think war, oil spike, inflation, recession. That, as I mentioned, that's a 1970s playbook. Now, I think investors are missing at least 3 things as it relates to the 1970s. The first is energy is far more diversified these days. In the 70s, OPEC controlled something like 50% of global supply. Today, it's closer to 30%. You look at the second thing would be that global trade flows are very highly adaptive. And we saw that with the Russia-Ukraine war, as I mentioned. It was sort of a real world test, and oil didn't disappear, just simply rerouted. And, in this multipolar world that we have with lots of backdoor channels, that type of thing, without being too cynical, oil kind of found its way to the end customer. And then lastly, Roger, economies, this is the big difference for the 1970s. Economies are just far less energy intensive. In the 70s, the global economy consumed 3 times as much oil per unit of real GDP as it does today. The other thing is energy share. The energy share as a total of consumer spending is near historic lows. I mean, it's 3.7% in the United States as a share of total personal consumption. So, I mean, and, also the overall levels, like if you look at the inflation adjusted oil peak in 1975, it was about $245 a barrel. That's on WTI. If you look at the nominal peak back in 2008, which was $147 a barrel, that's about 222 in inflation adjusted terms. So I think the bottom line is that oil shocks do matter, but they just don't carry the same macroeconomic punch that they once did, particularly versus the 1970s.
And what kind of a factor then is the reports that we're getting that facilities are being damaged in that area? I saw with the Qatar, the natural gas, they were talking 3 to 5 years to rebuild that. What kind of an impact does that have?
Yeah, we're following that closely. I mean, again, this is not to minimize what what's going on. The war is serious, and it will impact risk premiums in the global energy markets. So what happened in Qatar yesterday with they're forecasting that 17% of the production will be damaged for the next 3 to 5 years. So there is some longer lasting damage. But I think the main point is that when the market gets really obsessed with a certain thing, and we go back to these supply shocks again, COVID was obviously a big thing, but the Russia-Ukraine war, tariffs were a very good example last year because the market just became super focused on tariffs are going to send us back to the 1930s. And of course, the macro backdrop is much larger than that. There's policy, there's earnings, there's cost of capital, there's all those types of things. So, us as a team at Forstrong are thinking that this is going to cause long-term higher oil prices, higher natural gas prices, et cetera, et cetera. But we're focused on, does it short circuit the trends that we saw before the Iran crisis, and to a larger extent, does it short circuit the cycle that we've seen that came out of COVID?
And I just want to sorry, yeah. Go ahead, finish your thought.
Yeah, just does it short circuit? Like we've had a cycle of higher fiscal deficits, corporate earnings that keep surprising, recession that sort of never materializes, and we've called this the high pressure economy, right? We're in a higher nominal growth and higher inflation period, and we don't think that the oil crisis, at least now, derails that at all.
All right, and I want to get to just quickly. We went a little long talking about everything that's unfolding right now. A couple of the ETFs that you're liking. Japan, the Franklin FTSE.
Yeah, so we're looking at, we've had this big sell-off. There's a lot of emotions in markets, so we're looking at what's sort of been indiscriminately sold off, and what trends are going to be more durable after this crisis. Japan imports 100% of its oil. 90% of that comes through the Strait of Hormuz, so we know that's something that has been sold off aggressively. The Japanese story is great. It's under-owned in global portfolios. It's levered to a global recovery. This Franklin FTSE Japanese ETF has lots of industrials and lots of things that we like to see in what we've called the revenge of the real economy, this ongoing super cycle CapEx boom that we think accelerates with the Iran crisis.
All right, Europe, the iShares MSCI Europe Financials.
Yeah, we've held this one for a while, Roger. It's the European banking sector, just in short. And, again, looking back at the durable trends, Europe is in a classic cyclical recovery. We've seen wage growth go up. We've seen earnings go up. And this is coming off the back of like Europe, where nobody had anything good to say about it. So we think Europe as a major oil importer is one of those things that's been indiscriminately sold off. Will higher energy prices impact the entire region? Of course it will, but again, we don't think it's enough to derail some of these longer term trends. So this is kind of our shopping list right now as we look forward.
Okay, we got to wrap it up there, Tyler, but thanks very much for joining us today.
Thanks, Roger. Good to be with you.
Cheers. Tyler Mordy is CEO and CIO of Forstrong Global.